Monday, February 9th, 2026. Gold opens at $5,020 per ounce. Not a spike, not a correction. A hold, the price is theater. What's underneath is structural. China told its banks to limit U.S. Treasury exposure 12 hours ago. The dollar index is down 10% year over year. Central banks now hold more in gold than in dollar debt. If you don't understand what's connecting these three events, you will lose money in the next 18 months. I'm Edward Murrow. Let's follow the math. Gold, $5,012 per ounce, February 9th. Silver hit $121 in January before crashing 30%. The U.S. dollar index fell to 97.01, the lowest in 4 years. China's gold reserves jumped $50 billion in 1 month to $369.58 billion. U.S. national debt, $38.56 trillion. Interest payments on that debt, $426.9 billion spent so far this fiscal year. Net interest will cross $1 trillion in 2026. 10-year Treasury yield 4.21%, 30-year 4.85%. The dollar's share of global reserves dropped to 56.92% in the third quarter of 2025. That's down from 58.51% 6 months earlier. But that wasn't the real story. The real story happened this morning. Bloomberg reported Chinese regulators advised financial institutions to rein in holdings of U.S. treasuries, citing concentration risk and market volatility. China's treasury position, $682.6 billion, the lowest since 2013. They've been selling while buying gold for 15 consecutive months. That convergence, gold holding above 5,000, the dollar breaking 4-year lows, and Beijing explicitly telling banks to reduce dollar exposure, that's not a coincidence. That's coordination. Here's what nobody is connecting. The Federal Reserve has kept rates elevated to defend the dollar and suppress inflation. That worked until the cost of defending the currency became larger than the benefit. Interest on $38 trillion of debt at 3.35% average rates is now the third largest federal expense after Social Security and Medicare. It eclipses defense spending. 2. Trump's tariff regime collected an estimated $287 billion in customs duties in 2025, nearly triple the prior year. Tariffs are a consumption tax. They raise revenue but suppress imports and strengthen the dollar in theory. Except the dollar is collapsing anyway, down 10% year over year. Why? Because foreign buyers of treasuries are stepping back. When tariffs reduce your export revenue to the U.S., you have fewer dollars to recycle into bonds. 3. China is running the playbook that worked for the United States in 1971. Divest from the hegemon's debt, accumulate hard assets, build alternative payment rails. Beijing isn't just buying gold, they're building BRICS payment infrastructure, a blockchain-based settlement system that bypasses SWIFT. Russia, India, Brazil, South Africa, Saudi Arabia, and now over 30 candidate nations are negotiating terms. 4. Gold didn't rise because of inflation expectations. Core CPI is stable. Gold rose because central banks bought 863 tons in 2025 and are projected to buy 585 tons per quarter in 2026. That's $2.34 trillion moving out of sovereign bonds and into metal. Connect the dots. High rates defending the dollar increase debt service costs. Tariffs suppress the trade partners' ability to buy bonds. Trade partners shift reserves into gold and alternative currencies. Dollar share of reserves falls. To stabilize, the Fed would need to cut rates, which risks inflation and further dollar depreciation. To defend, the Fed would need to raise rates, which pushes interest costs toward GDP-threatening levels. This is a monetary trap with no exit that doesn't involve pain. The reserve fracture sequence, I call this the reserve fracture sequence, 4 stages. Every reserve currency transition in history followed this pattern. We are in stage 3. Stage 1, deficit without consequence. The reserve issuer runs persistent trade and fiscal deficits because foreign holders recycle surpluses into the issuer's bonds. The U.S. did this from 1945 to 2000. Deficits were tolerated because treasuries were the only deep, liquid, safe asset, and the dollar was the only settlement currency for oil, commodities, and trade. Stage 2. Doubts emerge. Alternatives build. Foreign holders begin to question sustainability. They see debt rising faster than GDP. They see the issuer using sanctions and financial surveillance as geopolitical tools, which makes holding the reserve a liability. They start experimenting, currency swaps, local settlement agreements, gold accumulation. The U.S. entered this stage after the 2008 financial crisis. China launched currency swap lines in 2010. Russia sold half its treasuries after 2014 sanctions. Stage 3, the tipping point. Flows reverse. Reserve holders don't just stop accumulating, they actively diversify and reduce exposure. The issuer must now finance deficits with domestic buyers and higher yields. This is where we are. China cut Treasury holdings from $1.31 trillion in 2013 to $682 billion in 2026. Central banks' gold holdings now exceed $4 trillion, surpassing their collective Treasury positions. The dollar share of reserves fell below 57%. That's the lowest in 3 decades when adjusting for valuation effects. Stage 4, collapse of confidence, replacement by distributed system. No single currency replaces the former reserve. Instead, a multipolar system emerges. Regional currencies for trade, gold for settlement, digital tokens for cross-border transfers, baskets for reserves. The transition is chaotic. Interest rates spike. The former hegemon faces a choice: default through inflation or austerity through cuts. Both are politically catastrophic. We are in stage 3, the flows reversed. That's what $5,000 gold is telling you. Proof 1. The Dutch Guilder, 1780-1815. The Dutch Republic was the reserve currency power of the 17th and 18th centuries. Amsterdam was the financial center. The guilder was the settlement standard for global trade. Stage 1. Deficit without consequence. The Dutch ran trade surpluses but financed foreign wars and infrastructure through bonds, which the world happily bought. Stage 2. Doubts emerged after the Fourth Anglo-Dutch War in 1780. Britain's naval blockade disrupted Dutch trade. The Republic had to borrow at higher rates. Rivals began settling in other currencies. Stage 3. The flows reversed during the Napoleonic Wars. France occupied the Netherlands in 1795. Foreign holders liquidated guilder bonds. Borrowing costs spiked to double digits. Stage 4. By 1815, the guilder was a regional currency. Britain's pound sterling took over as the new global reserve, backed by the world's dominant navy and the newly established gold standard. What preserved wealth? Those who held physical gold and British consols, government bonds in the rising hegemon, survived. Those who stayed in guilder bonds lost 70% of purchasing power. Proof 2. The British pound, 1914 to 1971. Britain entered World War I as the uncontested reserve power. The pound was backed by gold, managed by the world's most powerful central bank, and used in 80% of global trade. Stage 1. Deficit without consequence. Britain ran an empire and financed it with bond issuance that global investors absorbed. Stage 2. Doubts emerged after World War I. Britain suspended gold convertibility during the war, resumed it in 1925 at the wrong rate, and then abandoned it again in 1931. The U.S. was accumulating gold. By 1940, 70% of the world's monetary gold sat in U.S. vaults. Stage 3. The flows reversed after World War II. The Bretton Woods Agreement in 1944 made the dollar the primary reserve, convertible to gold at $35 per ounce, while other currencies pegged to the dollar. Britain tried to maintain reserve status through the sterling area, but suffered repeated devaluation crises in 1949 and 1967. Stage 4. The pound became a secondary currency. In 1976, Britain required an IMF bailout. Inflation hit 25%. The government imposed capital controls and spending cuts. What preserved wealth? Gold, held privately or through Swiss accounts. U.S. equities. Real estate in non-sterling jurisdictions. Sterling bondholders saw 50% real losses over a decade. Proof 3. The U.S. dollar's first break, 1971. The dollar was backed by gold under Bretton Woods. The promise any foreign central bank could exchange $35 for 1 ounce of gold. Stage 1. Deficit without consequence. The U.S. ran guns and butter policy in the 60s, financing the Vietnam War and Great Society programs with deficits. Foreign central banks recycled trade surpluses into treasuries because they believed in the gold peg. Stage 2. Doubts emerged in the late 60s. France, led by Charles de Gaulle, began exchanging dollars for gold. U.S. gold reserves fell from 20,000 tons in 1957 to 8,000 tons in 1971. Stage 3. The flows reversed in August 1971. President Nixon closed the gold window. The Smithsonian Agreement tried to salvage the system with wider currency bands. It failed within 2 years. Stage 4 didn't happen. Why? Because there was no rival with the economic scale and military power to replace the dollar. The Soviet Union had neither the currency nor the markets. Europe was fragmented. Japan was a defeated former enemy rebuilding under U.S. military occupation, so the world accepted a fiat dollar system by default, backed not by gold but by the size of the U.S. economy, the depth of Treasury markets, and the dominance of American military and technology. But here's the killer stat. Gold rose from $35 in 1971 to $850 by January 1980. That's a 2,400% increase in 9 years. It wasn't a speculation trade. It was a revaluation of monetary reality. What preserved wealth? Gold, Swiss francs, German marks, and hard assets like oil, real estate, and commodities. Dollar holders who stayed in cash or bonds saw 70% purchasing power destruction after inflation. Now overlay those three patterns on today. Let's reconstruct the recent sequence day by day, because this is where the crack became visible. January 21st, 2026. Morgan Stanley publishes a note titled, U.S. Policy Factors Critical to Extent of De-Dollarization Shift. The firm notes that central bank gold reserves are worth around $4 trillion, more than their collective holdings of U.S. treasuries for the first time in modern history. The report states that the doubling of gold prices over 18 months is driving this shift. January 23, 2026. Bank of America issues a forecast calling for gold to reach $6,000 per ounce by spring 2026, citing a historical average of 300% price increases during past bull markets over 43 months. January 25, 2026. Gold breaches $5,000 per ounce for the first time, closing at $5,058. CNN attributes the surge to Trump turmoil and global concerns. The Guardian headlines, Gold price jumps above $5,000 an ounce for first time amid Trump turmoil. January 26, 2026. Silver hits an all-time high of $121.64 per ounce before crashing 36% over the next week. CNBC reports that hedge funds and retail traders poured into precious metals as a hedge against both tariff-induced inflation and geopolitical instability. January 29, 2026. The dollar index falls to 99.3, about 2.4% below its average over the prior 6 months. Analysts cite reduced confidence in U.S. fiscal policy and renewed concerns about debt sustainability. February 2, 2026. The U.S. Treasury announces it expects to borrow $574 billion in net marketable debt during the January to March quarter. That's on top of the $2.32 trillion added in the prior 12 months. February 4, 2026. Wells Fargo Investment Institute revises its gold target upward to $6,100 to $6,300 per ounce by year-end, citing sustained central bank demand and structural dollar weakness. February 7, 2026. Reuters reports that China's central bank bought gold for the 15th consecutive month. The value of China's gold reserves rose to $369.58 billion, an increase of $50 billion in 1 month. February 9, 2026, morning. Bloomberg breaks the story. Chinese regulators have advised financial institutions to limit U.S. Treasury holdings due to concentration risk and market volatility. This is the first time in modern history that Beijing has given explicit guidance to reduce dollar exposure. February 9, 2026, market open, gold opens above $5,000 and holds. The dollar index falls to 97.01. The 10-year Treasury yield ticks up, reflecting reduced foreign demand. This is the timeline. This is how reserve fractures begin, not with a declaration of war, but with a coordinated, quiet reallocation of trillions in capital. Let's run the Stage 3 checklist. 6 characteristics. If we see all 6, the fracture is confirmed. 1. Sustained reduction in reserve holder accumulation of the incumbent currency. Check. The dollar's share of global reserves dropped from 58.51% in Q1 2025 to 56.92% in Q3. That's 1.59 percentage points in 6 months, the fastest decline in a generation when adjusted for valuation effects. 2. Central banks shift into alternative assets, primarily gold. Check. Central banks bought 863 tons of gold in 2025 and are expected to average 585 tons per quarter in 2026. China alone added $50 billion to gold reserves in 1 month. 3. Widening interest rate spreads as the issuer must offer higher yields to attract buyers. Check. The 10-year Treasury yield is 4.21% as of February 9th, while inflation expectations remain subdued at around 2.5%. That's a real yield of 1.7%, the highest in 15 years. Higher real yields are necessary to compensate for perceived risk. 4. Emergence of alternative payment and settlement systems. Check. BRICS nations are building a blockchain-based payment network. The RMB's share of global SWIFT payments is 2.7%, small but growing 12.65% month over month. Russia and China are settling energy trades in yuan. Saudi Arabia is negotiating oil contracts in non-dollar currencies. 5. Explicit policy statements from rival powers signaling intent to reduce reliance. Check. On February 9th, Chinese regulators advised banks to limit U.S. Treasury exposure. In early February, Chinese President Xi Jinping publicly called for the renminbi to become a global reserve currency. That's not speculation. That's declared policy. 6. Rising cost of debt service approaching fiscal unsustainability thresholds. Check. Interest payments on U.S. debt are projected to reach $1 trillion in fiscal 2026, equivalent to 3.2% of GDP. That exceeds the previous record set in 1991. At current rates, interest costs will surpass defense spending and become the second largest line item in the budget within 2 years. All 6 boxes, checked, documented, verifiable. We are in stage 3. Let's destroy the 3 objections you're hearing. Objection 1. Technology and productivity growth will save us. AI will unleash a new economic expansion that grows us out of the debt. Crush. Technology increases output, but it doesn't fix monetary imbalances. Britain had the Industrial Revolution in the 19th century. Steam engines, railways, textiles, the most advanced technology on Earth. It still lost reserve status because it couldn't sustain twin deficits and honor gold convertibility. Productivity growth in the U.S. averaged 1.5% annually from 2000 to 2025, below the post-war average. Even if AI doubles that, which is optimistic, it doesn't change the fact that debt is growing at 6% per year, while GDP grows at 2%. Math doesn't negotiate. Historical parallel. The Soviet Union in the 1980s had nuclear weapons, space technology, and advanced engineering. It collapsed because the fiscal model was unsustainable. No amount of tech innovation prevents a balance sheet crisis. Objection 2. The U.S. is too big to fail. The world needs dollar liquidity. There's no alternative with the scale and depth of treasury markets. Crush. That was true in 1971. It's not true now. China's bond market is the second largest in the world at $22 trillion. The euro bond market exceeds $15 trillion. BRICS nations represent 46% of global GDP at purchasing power parity as of 2025. They don't need to create one single replacement currency. They just need to reduce dependence by 20% and the math breaks. If dollar reserve share falls from 57% to 45%, the U.S. loses the ability to finance deficits at low rates. The difference between funding at 4% versus 6% on $38 trillion is $760 billion per year in additional interest, more than the defense budget. Historical parallel. Britain in 1945 was too big to fail. It had the world's largest empire, the most sophisticated financial system, and a centuries-old track record. Within 30 years, it required an IMF bailout and capital controls. Objection 3. American exceptionalism and institutional credibility will preserve trust. The Fed and Treasury are the most trusted institutions in the world. Crush. Trust is earned through consistency. The U.S. closed the gold window in 1971, breaking a treaty obligation. It weaponized the dollar with sanctions against Russia in 2014, Iran repeatedly, Venezuela, and now threatens tariffs and financial exclusion against allies. Every time the dollar is used as a political weapon, it creates an incentive for rivals to build alternatives. The Fed's credibility eroded when it missed the inflation surge in 2021, calling it transitory, then pivoted to the most aggressive rate hike cycle in 40 years. Institutions preserve trust through predictability. The current regime is anything but predictable. Historical parallel. The Roman Empire had the most trusted coinage in the ancient world for 3 centuries. When emperors started debasing the denarius, reducing silver content to fund deficits, trust evaporated within 2 generations. By the 3rd century, merchants refused Roman coins and demanded payment in gold or barter. Institutions don't preserve currency stability, balance sheets do, and ours is broken. Disclaimer, this is educational analysis, not financial advice. Consult a fiduciary before making investment decisions. That said, let's talk about principles. The reserve fracture sequence doesn't end with a single crash. It unfolds over years with volatility, false recoveries, and policy interventions. The question isn't whether to panic, it's whether you understand the pattern and position accordingly. Core principles in a stage 3 fracture. Principle 1, hard assets. Gold, silver, and other commodities with no counterparty risk. In every reserve transition, those who held metal preserved purchasing power. Gold at $5,000 is not expensive if it's going to $8,000. It's not speculation, it's monetary revaluation. Principle 2, productive assets in growth regions. Equities in companies that generate cash flow in non-dollar markets. Real estate in jurisdictions with controlled debt and stable rule of law. Infrastructure, energy, agriculture, assets that produce real output regardless of which currency dominates. Principle 3, diversification across currencies and geographies. Don't be denominated in one reserve system. Hold baskets. The Swiss franc, Singapore dollar, Norwegian krone, currencies backed by surpluses, low debt, and resource wealth. Principle 4, liquidity and flexibility. The transition is volatile. You need the ability to move capital quickly. Avoid illiquid assets, avoid leverage, avoid lockups. In stage 4, capital controls and confiscatory taxes are common. Principle 5, skills and networks. In every reserve collapse, human capital becomes the most valuable asset. Learn skills that translate across borders. Build relationships in multiple jurisdictions. Be mobile. Now let's contrast 2 scenarios. Scenario A, the unprepared saver. This person holds a 60-40 portfolio of U.S. stocks and bonds, all dollar-denominated, in a tax-deferred retirement account. No gold, no international exposure, no alternatives. If the dollar loses another 20% of purchasing power over the next 5 years and interest rates spike, the bond portion collapses in real terms and the stock portion underperforms inflation. At age 65, this person discovers their nest egg buys 30% less than they planned. They can't retire on schedule. They're forced back into the labor market in a contracting economy. This is the modal outcome for tens of millions of Americans. Scenario B, the pattern-aware allocator. This person holds 15% in physical gold and silver, stored outside the banking system, 20% in international equities across Asia, Europe, and emerging markets, 20% in inflation-protected real assets, farmland, timber, energy infrastructure, 30% in a diversified basket of cash and short-duration bonds in multiple currencies, 15% in high-quality domestic equities with pricing power and international revenue. When the dollar depreciates and yields spike, the gold allocation offsets losses. The international equities benefit from non-dollar appreciation. The real assets produce income in rising nominal terms. This person doesn't get rich, but they preserve capital through the transition and can redeploy when the new system stabilizes. The difference between these 2 scenarios is education and positioning. That's why you're watching this. Here's what to watch. Short term, next 3 to 6 months. Gold likely consolidates between 4,800 and 5,500. Central banks continue accumulating. The Fed faces pressure to cut rates due to slowing growth, but holds off due to inflation fears and dollar defense. Treasury yields stay elevated, which increases deficit financing costs. China continues reducing Treasury holdings gradually to avoid triggering panic. Volatility increases in currency and commodity markets. Medium term, 6 to 18 months, one of 3 catalysts triggers the next leg down in dollar confidence. Catalyst 1, a failed Treasury auction where the government must offer significantly higher yields to clear supply. Catalyst 2, a major trade partner, Japan, South Korea, or a Gulf state, announces a policy shift toward reserve diversification. Catalyst 3, inflation reaccelerates due to tariff pass-through, and the Fed is forced to choose between defending the dollar with rate hikes or defending the economy with cuts. Either choice breaks something. Long term, 18 months to 5 years. We move deeper into stage 3 or enter stage 4. Gold rises towards $6,000 to $8,000 per ounce as central banks and private buyers seek monetary safety outside the dollar system. A multipolar reserve system emerges with regional currencies, gold settlement, and digital payment networks. The U.S. faces a choice: inflate the debt away, which destroys the dollar's purchasing power, or impose austerity, which triggers political and social crisis. Neither is politically feasible, so the likely outcome is a managed decline with stop-start interventions, volatility, and partial defaults through inflation. 3 signals to watch. Signal 1. If the dollar's reserve share falls below 55% in the next IMF COFR report, that's acceleration. It confirms flows are not just pausing, they're reversing faster. Signal 2. If any G7 nation other than the U.S. announces a policy to diversify reserves into gold or non-dollar assets, that's contagion. It means the fracture is no longer U.S. versus China. It's the entire Western alliance questioning dollar primacy. Signal 3. If gold breaks $6,000 and holds for more than 30 days, that's confirmation of stage 4 entry. At that point, the repricing is no longer speculative. It's structural and irreversible, without a massive policy reset. History doesn't negotiate. The reserve fracture sequence has run 4 times in the past 3 centuries. It's running again. The only variable is how fast. $5,000 gold is not the story. It's the signal. The story is what comes next. I didn't tell you what happens when Japan or Germany makes the same move China just made. That's next week's video, linked in the end screen. Subscribe now so you don't miss the catalyst event that pushes us into stage 4. The math is running. Let's stay ahead of it.